All right, everybody. Welcome to all the new faces. I see a lot of new faces here. Welcome to Quant Data Q&A Market Prep. It's Sunday, so my hair's a little bit of a mess. I got my glasses on. Got this home T-shirt on, but don't judge me. Don't judge me because it's Sunday. Man, I'm not going to change for this. Right? But yeah, welcome to all the new people. We run these every Wednesdays and Sundays, 5 p.m. PST, for you guys, for the community, so you guys can ask questions, get involved with the chat, and just prepare for the market together with us. Right? That's always fun. We always say here in Quant Data, a prepared trader is a real trader. Right? An unprepared trader is just a gambler. Might as well go to the casino and put your money towards roulette, or buy the ABJ meme coin. I'll start that up, man. If y'all want to give me some money and let me rug pull you, I'll do it. I'll do it for the money. All right, so today gonna do a little bit, just a few things differently. I think that as the market progresses and as the market provides us with more opportunities. I know I'm always an example, right? I'm always an example for you guys. And I'm happy to be that example. I love trading the market. I love showcasing quant data and all our tools. And I love using the tools, right? This is the stuff that pays my bills. So I wanted to go through, I made a little bit of a slideshow. It's nothing crazy. But a lot of people ask these questions. And I think me recording this video today for you guys, me going over this today with you guys is going to answer a lot of questions, and I can always refer back to these, to this presentation specifically. So today on the agenda, we're going to go through this slideshow. I called it Why Spreads, an ABJ introduction. Right, we're going to quickly go over the overview of why we trade spreads first and foremost compared to other trade structures. Okay, so I know there's a lot of people that wonder, like ABJ, why are you trading a spread? What is a spread? What is it? Well, hopefully this is good. Again, this is just a brief overview. We're going to talk about spreads. We're going to talk about really briefly what is a credit spread, and then we're going to talk about all the different trade structures that exist, and then you'll see, hopefully through this presentation, why we do spreads first. Okay, so who's ready? Who's ready with me for this one? And then after that, so after the slideshow, we got economic events. I'm going to go through that. Also earnings. I know there's one really big important earnings that has my name in it. 6,500 SPX. We're going to see if that is still coming through. I know we were targeting 6,400 last week. And then I'll quickly do a Q&A. So I will definitely leave some room for afterwards for you guys to ask questions. Right, so first of all, we're going to do why spreads. Right, so why spreads? A quick overview of why we trade spreads first and foremost compared to other trade structures. So show of hands in the chat. Show of hands in the chat. Do you guys know what a spread is? What is a spread? What is a credit spread? Do we know? Well, to understand a credit spread, firstly, we need to understand what options actually mean. So in the chat, really quick. Sorry about that. Let me turn my phone off. I did not know it was going to blare like that. Let me turn my other phone off as well so Carmen doesn't... Just in case, Carmen messages me. I'll be like, oh, sorry, my phone was off. I didn't hear you want to yell at me. My bad. Okay, so for what is a call option? Who knows in the chat really quick? What is a call option? What does it mean when you own a call? Someone in the chat. Will there be some star Bs given out today? Very possible. There is a possibility. Yes, I'm gonna put this over here just so you guys can see. So okay, perfect. LJ, right to buy at a certain price on a certain not on a certain day, not on a certain day. It's buy a certain day. Okay, so no one has really the fullest answer there. This answer right now tell you right now, Max, it is wrong. So what is a call? What does it mean to own a call? So a call option, what it means is the right to buy 100 shares at the strike price from now until the expiry date. Okay, so that's what it means to own a call option. It's a right. So if I own a call for, I don't know, SPY 650, I'm just going to say SPY 650. I have one call option. Now I have the right now, if it goes through, let's say SPY goes to 651, and I own that call, I have the right to buy 100 shares at 650, even though price is at 651. That's what it means. Okay? So that's what it means to own a call option. What is a put? So what does it mean when you own a put option? Who knows? In the chat. So there's still some gift cards available for everybody. That question there, no one got it, so we're not gonna give you all free gift cards, man. All right, okay, so the full explanation, please. The full explanation, not just yes, bok choy. Okay, right to sell at the price before expiration. So a put is the right to sell 100 shares at the strike price from now until the expiry date. So I'm gonna write that. This is the put, and then up here is the call. Can everyone see this, by the way? I know Discord's a little bit blurry sometimes. Yeah, Hargan. Okay, cool, perfect. So now that we've established this, right? So I'm gonna write this bok choy Starbucks. Okay, so I remember. So I'm gonna send you a Starbucks gift card after. Now, so we understand what it means to own it, right? To own these contracts. Okay, so what does it mean when you sell to open it? So what does it mean when you sell a call into the market? You are now -1, -1. Right now, that means if you sell a call, you've given someone in the market to buy 100 shares from you at that price. If it goes through, right? If it goes through that price, let's say I sell a call for SPY at 650, all right? I sell a call for SPY at 650. SPY is now at 655. Would it make sense for the person who owns a call to exercise their right to buy 100 shares of SPY from me at 650 when SPY is at 655? Yes, right? It does mean it is a good idea for them to exercise that call because they are now net positive $5 whole. $5 whole. Same thing for a put, right? If you sell a put into the market, if price goes down to whatever, like let's say SPY 650, someone has the right to sell you 100 shares of SPY at 650, even if SPY is at 640, and you are obligated to do so. Correct? Everyone understand so far? So if we inverse it, you are giving the market, right? Let's just say the market. We're not going to make it too much of a variable on individuals. But if you sell a put, you sell a call, you're giving the market the right to exercise their call or put options on you. You are taking the risk. But when you sell those contracts into the market, you take the premium. You get the premium for that risk, right? So really quickly, I'm going to go through this again for everyone, but we're going to go through this really quick, okay? So let's say you have SPX. Now this is cash settled, of course, right? So we're putting it all together now. So what does it actually? Let's do a better ticker. Let's just do like, I don't know. Let's do Webull, for example. Let's just do Webull. Gives us a little bit more. So let's say by August 30th, 30 days from now. Now I want to sell premium on puts. Like I want to collect premium puts. Let's say 12. So I do 12. I collect 47 cents on that, but I'm going to buy 11. All right, so let's do that. So we're going to go to the equity curve. Okay, so what this means is that so long as price doesn't come down to 12 in the next 30 days, I get to keep $27. Now what happens? What happens when we lose this trade? Let's say price comes all the way down to 10. What does it mean when it comes down to 10? Just really quickly. What does it mean? Now, obviously someone's going to exercise their 12 on us, right? So we've collected $27 for this. We are obligated to buy 100 shares at $12, but we own an 11 put. We own an 11 put, which means it gives us the right to sell 100 shares of Webull at 11, even if price is at 10. We're not going to talk about it coming in between. We're going to get through that another day. But so this is what it means to have a spread on. Okay, this is what it means to have a spread on. Now we're going to talk about the benefits of a spread. We're going to talk about why we trade these primarily. But everyone understands it so far, right? So we talked about what it means to own a put, what it means to sell a put. So we've sold at 12. We are giving the market the chance to sell us $12 shares of Bull. But we also own an 11 put. So it gives us the opportunity to sell Bull at $11 if, it comes well below 11. Okay? I'm going to move on. I don't want to confuse you guys too much, but this is a good start. Move on really quick to the next slide. So that's what a credit spread is. We're buying simultaneously selling a put and buying a put, and then same thing for a call side. So with that being said, that's spreads. So what are actually all the ways that we can trade the intraday market? Okay, there's 4 ways that we can trade the market. I don't want to say intraday. I'm actually going to remove that. Trade the market in general, okay? So 4 ways primarily. We can sell options. Okay, we can sell options. We can buy shares. We can also short shares, but not everyone does that. Mainly buy shares. Let's just stick to the basics there. We can buy options, and we can use futures to go long or short. So we can buy futures, and we can also short futures. Okay, so these are primarily the 4 ways that we can trade the market. Okay, everyone understands these instruments? Thumbs up in the chat. Questions, I'll take them after. I'm going to take the questions after, so don't, if I do forget, just remind me afterwards. This presentation won't be too long. So hopefully you guys got that. So these are the 4 ways. Now, this is how I like to do it, right? This is the ABJ way of splitting these instruments up. Now, I have made a totem pole. Kind of a totem pole of trade instruments in order of probability. Okay, so probabilistically, we know which trade structures are just always going to be better than the other. That doesn't mean that we can't trade the other ways, but it just means that there is a better environment for each one. Okay, so naturally, credit spreads is going to be primary. So credit premium is primary in this totem pole, so it's number 1. Credit spreads by structure have the highest probability of success. This is because we are not calling for a direction in price. When you trade a credit spread, you're not calling for a direction. We're either calling a floor, ceiling, or both. So if we sell a put in the market, we're saying that price is not going to come to this level. Okay, and I'm going to show you some charts. At the end of this, we're going to show you some charts. If we sell a call, we're saying price is not going to surpass this level, right? And so as time goes on, right, we benefit from time decay, aka theta. We benefit as IV depletes, so IV contraction. And also with credit spreads, we're not going to go over this today, but we benefit from being able to roll our positions on a longer time frame when we are wrong. So we talk a lot about this in stream, but let's say we're selling a put credit spread. We win whether the market goes up, goes sideways, or even down, so long as it does not hit our sold leg. So the premium that we collect from the market, we keep it as long as the market doesn't surpass our leg that we've sold, that we're the short leg that we're in the market. Thumbs up in the chat if you understand so far. Again, I understand there might be some questions. I'm going to answer them later. Give me like one thumbs up so I know someone's listening to me here. 59 people. Oh, I love it. I love it. Thank you. Thank you. So, continued. In the totem pole of trade structures, number 2 is shares. Why is shares number 2? So shares remain flat. There are no fluctuations in premium because shares have no premium. This asset can also be hedged cost effectively with options. If I own 100 shares of Bull, I can sell covered calls, right? And that's a win-win trade. If price comes down or price does nothing, my calls decay. So I collect the money for that call that I've sold into the market. If Webull goes up, surpasses my call, the market exercises the contract, I get to keep the premium that I got from the covered call. I also get to sell my shares at a higher price. Same thing with cash secured puts. You keep the premium, you sell a cash secured put, meaning that you're telling the market you're willing to take 100 shares at this price, just pay me for it, right? So that's how you can hedge effectively with options. This asset also has no downside to dollar cost averaging, so long as you continue to collect premium on your position to counter costs of accumulating shares. So let's say Bull comes down from 16 to 14 and you buy 100 more shares. Well, now your average is lower. And when your average is lower, what can you do now? You can sell covered calls at an even lower strike, collecting more premium, and you can sell double the amount of covered calls. So let's say you pick up another 100, right? For every 100 shares, you're allowed to sell one covered call. Also with shares, stop orders are less likely to gap, and sell limit orders benefit from gaps. Think about options. So anyone who trades options, like myself, anyone who trades a lot of options, what happens when IV does something crazy and we go through, like if you buy a call at $2, you set a stop at 150, and then wake up next morning that call's worth 90 cents. What happens? Does it automatically fill? No, your broker's just going to give you a warning saying that, oh, you messed up, right? You messed up. You got to adjust your position now to change your stop. Shares doesn't happen as often because of the liquidity and because of the bid and ask. It's always going to be the same. Usually those gaps, they'll fail you at the best price. There are also times with, this is an options thing specifically, when options gap up and you had a sell limit at some place. Let's say you had a SPY call at $1 and you set a sell at 1.2, like 1.2, and then the market gaps up to 1.5. You're gonna get sold at 1.2, even though it's worth 1.5. That's just the nature of options. It's because of the bid ask spread and things like that. Again, shares, that doesn't happen as often. Number 3. So number 3 on the totem pole is futures. So we all love futures here, especially intraday trading. Futures is fantastic. It's very quick. Mental F1, we really relate futures to mental F1 because split second decisions, entries and stuff like that really matter. They're really important. So futures are leveraged without the volatility impact. This instrument is highly liquid and has a flat curved P&L. Entry price, level, entry, and exit. Every price level, entry, and exit has a defined P&L. Nothing can affect this asset's premium. My example is 4 points on ES, which is SPX, right? Will always be worth $200. At no time would it ever be worth different unless they change the entire market, right? Now, whoever trades options, $4 on SPX on your call option, is it always going to be worth $200 up? No. No, it will not. And we're going to go through this. So this is number 3 in terms of probability, right? Number 4, so long options. This is the least probabilistic trade structure that exists. This is also known as debiting. So when you buy a call, when you buy a put, this is you debiting. You are spending money to buy these assets. Long options are the last trade structure for probabilities, especially naked long options, right? So if you buy just 0 DT calls or whatever, puts, this carries the most risk as you're both battling time. You're battling against time and IV. So all out of the money options always expire worthless, right? We all know that that's the one truth about options. All out of the money options expire worthless. Whether you buy a SPY call $2 out for $1, by the end of the day, if it never crosses, it's going to lose value. Something that a lot of people don't know as well, that us options traders know, us people here in quant data know, is that in the money options actually suffer as well. So in the money options still get affected by IV contraction. What is IV contraction? Well, when price starts to settle and does nothing, right? When price starts to just coast like we've had, we've all seen consolidation days where SPX moves, I don't know, like $10 the entire day. In the money options actually lose value. And that is because the interest is gone. The implied volatility is starting to leave those options contracts. And so as that happens, yes, charm gets stronger, but IV does have a big factor in pricing these. So because of this, we only want to focus on debiting when we are truly confident in a few things, which we're going to shortly share here. So, one of the main things is you really want to participate in long options when you're confident that something big is going to happen, right? Otherwise, what's wrong with trading futures? What's wrong with trading shares? Nothing wrong with collecting credit as well, right? So this is my mindset coming into the market. So after 7 years of trading the market every day, this is the way that I like to think about trading the market, right? Because what is our goal in the market? Specifically for 0 DTEs, our goal is for cash flow, right? Hopefully that's for you guys too. Otherwise, I don't know why you're participating in 0 DTEs, right? But my goal, and a lot of the day traders that we speak to, your goal for trading 0 DTEs is to replace your income, right? Replace your job, replace whatever else it is. So my mindset for participating in the market is always let the market pay us first, right? Let the market pay us first, as in collecting credit, right? And I'm going to show you how easy it is to choose where to collect this credit. So what this means is, why not let the market pay us for carrying the risk, i.e. collecting credit, before we pay the market, right? So we want the market to pay us first before we pay them. When we focus on collecting credit first, we have a higher probability of success on a longer time frame than us always spending on debit trades, right? So if every day you come into the market and you say, I'm going to buy calls, right? How often are you going to be right? And what needs to happen for your calls to win? Well, what needs to happen if you continue to just buy calls every day is you need the market to go up, right? It can't just sit flat. You need the market to move with some sort of haste, and you need your call options to become in the money, right? So you need those three things. It needs to go up, it needs to go up fast, and you need the market to you need your strike to become in the money. So I'm going to type that out really quick for you guys. So if you just buy calls every day, right? Buy call, you need market to go up fast and contract to become in the money. Now, obviously, you can buy in the money contracts. Hopefully, you've seen the math and kind of the reason why we don't participate in buying in the money contracts unless you're doing some sort of debit spread, some risk-defined strategy. But otherwise, if you're just buying naked longs, you're actually at a disadvantage for buying in the money contracts. So we're going to go over that again next time if you guys don't remember. We're going to continue on though. Oh, so pros and cons of each. Oh, I did not know I could use the scrolly to do this. Oh, good to know. Good to know. Pros and cons of each. Okay, so with options, we can define our risk. we can structure a trade where we know exactly how much we can profit and how much we can lose. So in my example, I'm going to show you put credit spreads. It's just the easiest one to understand. So the pros of long options. Long options can capitalize on IV and gamma expansion, right? When we are very right on our direction. Think FOMC, think earnings. When you're very, very right, say you know FOMC, high probability that it's going to go up, and you buy calls, your contracts get extra juice, right? They get IV and gamma pricing in the deltas, and then increasing the deltas, and that delta increases the premium of your contract. But you suffer though. You suffer theta decay and when IV contracts. So again, kind of like what I'm talking about here. If you buy a call, what do you need from the market? You need the market to go up, and you need it to go up fast. That is how you benefit from call options. Otherwise, you're taking on a lot of risk for that participation. Short options, right? We miss out on gamma and IV expansion, right? Because it's a defined amount that you can earn already. But you benefit from theta decay and IV contraction. So time, right? As time goes on, as these contracts come to expiry, becoming closer to being worth nothing, we benefit on the other side of that. We also don't have to be right on the direction, right? Whether price goes up, down, or sideways, it doesn't matter. We sold the option. As long as it doesn't meet, we win the trade, right? Because of this structure, we increase our odds of success a lot faster, right? So again, I'm going to show you really quick, just really quickly, right here. So, that's not what I want to do. Hold on. Cross, okay. Right, so here's my example, right? So this is the day that I'm going to bring up as well for you, but in our later example. But if you go into the July 23rd, right, and you just sell puts, right? You just sell puts at 6,300, which is exactly what we did on that day. What needs to happen for price for you to win, right? It can go up, right, which it did. It could do nothing, but it can come down too. It just cannot come to 6,300. But if you buy calls here, let's say you bought calls right here, you saw the market juicing up, you're like, oh, we're gonna fly. How long do you have to hold that call for it to become in the money, or for you to win, right? Let's say SPX, right, 63.44, you bought calls. What happens immediately after? It came down, right? Now you're in the red. Now you're losing. Probabilistically, you're getting hurt. When does it come back to 63.44? A whole hour after. By that time, right, if you bought out of the monies, like you should have, you're cooked. Like, it's already so late for price to come back. Obviously, it came back, and we started to rally, but you were eating dirt for a good while if you bought calls here versus you selling puts here. I'm going to continue going so we can go through some of the examples, right? But this was the post. So I'll show you really quick in the chat. I just want to post it there so you guys can see it. That is the exact trade that we took that day. We sold 6,300, 62.95, 5 wide spread. We sold 7 for 0.7 credit. Was I worried? No. So I'm going to continue going. I just don't want to miss too much here. So that's short options. So pros and cons of each. Shares can be traded in all environments, so long as you hedge accordingly at all times. I'm always doing that. I'm constantly selling covered calls and cash secured puts to further increase the cash flow that I get. Lastly, futures benefit from having no theta effect, a flat P&L curve, but you miss out on gamma and IV. Expansion and contraction, right? Because these are flatly priced, same as shares, but there is leverage to them. So for example, if you trade futures on FOMC, a fun little bit of exercise that you guys could do is if you take a look at call options, out of the money call options, and how much they increased versus you going long on a futures contract. Just pick one. And you'll see the percentage from the IV and the gamma on those SPY or SPX calls, for example. They eclipse the futures by a lot. They eclipse the futures by quite a bit. So that's the pros and cons of each. What's my next one there? So in every environment, right, you have a different trade structure that's a little bit better. This is just a rule of thumb, and I really want to say this this last bit here emphasizes this doesn't mean you can't trade all structures just because of IV. It's just a rule of thumb. But generally, if we take SPX as an example, now every ticker has its own rule. So if you trade Tesla, if you trade Apple, it's going to be all based on the historical volatility. And with SPX though, because we trade a lot of SPX here, so I just want to use this as our example. So we use the IV plus or minus 30%. It's a great standard. This came from Tasty Trade. So I want to say that I didn't make this up. This is back tested with a lot of time throughout time. So IV over 30%, generally you have a higher success rate selling options. If we think back to tariff talk, right? When IV was constantly in the 30, 40, 50% range, what was I doing all the time? I was selling options to the market because you could get away with selling really far out options. Whereas right now, we're well under 30%, and we can only sell, like, let's say 2 to 3 strikes out. That's because IV prices in the expected range of the day, and when we can get a higher expected range, when IV is well over 30%, we can allow, like, the market allows us to sell really far out for some sort of credit. There's another rule of thumb that I like to do, and I'm going to type it out really quick. The minimum for a 0 DTE credit spread is 10%. So what this means is if I am putting up $500 of risk, I need a minimum of $50 collected in credit. Otherwise, it's not worth your time. Now, I know there were some people last week, I'm not going to name who, that was typing in chat saying they're collecting $15 of credit for $500 worth of risk. If you get blown out of the water with that, that's just unrecoverable, right? We've seen that happen before, right? These crazy, tweets from Trump, for example, that really just destroys us. And so we don't want to do that. That's my minimum. If it's not $50, just wait for the next trade. There's going to be another opportunity. Futures and shares, fantastic for both environments as they're flat again. But shares, remember to always hedge above 30%, right? So again, like let's say IV for Tesla is like, well above the means, the historical average. Well, then does it make sense for you to not be collecting premium on your shares? On the risk that you already have because you bought those shares, right? No, it doesn't. And again, this doesn't mean you can't trade all structures just because of IV. It's just a rule of thumb. But we're going to go on. We're going to talk about this, right? So this is something that I do a lot. And I know that I did this on this day, the 6300 day, okay? And with this, we're going to go over the examples as well. So ABJ financing. ABJ financing. Pay me before I pay you. Okay? Now, we're going to take a look at Wednesday. Without looking at how the day actually went, what do we see in the delta? So I'm going to show you the delta, and then I want you guys to remember this. So what's the most likely scenario for price? Okay, so I'm going to copy these questions. We're going to go here. We're going to go here. What am I doing? Right here. Okay, so this is Wednesday. Okay, this is the open of Wednesday. Now let's ask ourselves these questions. Based on what we're seeing, what's the most likely scenario for price? All right, I'm going to say yes, it's worth my participation. All right, but what do we see? What do we think? What do we think here? So left side is delta, right side is gamma. This is right at the open of the market. Who's faithful here? Who has some faith in this little study that we're doing right now? Who can tell me for one Starbucks gift card, one Starbucks gift card, what is the most likely scenario for price? What do you think? You think up. Why do you think up? Right? Why do you think that? What do we see that's telling you that the market should go up? It should go up, but it might not. Right? It might not. Oh, I like this. I like this. Ooh, okay. There's a lot of people saying a lot of things here. MVC above us, deck support behind us. Yes. Okay. So this is fantastic. This is fantastic. So I did just show you the tweet, right? The trade that we put on. We sold 6,300. Why did we sell 6,300 in the market? Right? Because we want to focus on let the market pay me first for the most highest probability trade. The most probabilistic trade. I don't need price to go up. I just need price to not come here. So this is your, oh, actually, let me go back here. So this is your day. Okay, now I'm going to show you the stock price right now. I'm going to show you the stock price. So this is the Wednesday. You see, as we moved on here, right? We know based on the delta profile that there's a high likelihood that we stay around 63.25 and 63.30. Where did we go? Right? There's a high likelihood here because these deltas are in the billions. Right? So does it make sense for us to short the market? Does it make sense for us to long the market? Right? So my immediate idea, because we stick to this mantra, I want the market to pay me before I pay you. So we sell puts into the market because we're bullish. Now, what levels are we selling? What's the price points of where we want to sell puts? We want to sell puts below this, making sure that these 63.25, 63.30 is going to help support us. It's going to help support us in this potential move up. I'm going to say potential move up. So how far can we go in the chain for us to collect 10%? At the time, we could go as far as 60, I think it was 62.95. But I chose to sell 6,300, collect a little bit more credit. I collected 0.7. I sold 7 of them, so it was pretty good money. Now, because these long deltas exist, I know this is what I run through my head. First thing, we're probably going up, but I don't know for sure if we're going to go up. Right? Why do I not know for sure that we're going to go up? What's our next point that we think about right here? This is, again, 15 minutes until market open, right? I think we're going to go up, but I don't know for sure. So because I don't know for sure, I'm going to trade the most probabilistic trade structure and make sure the market pays me first before I start spending money. So we collected 0.7 times 7, right, of credit. And now how much money has the market paid me so that I can spend on the market? So I can spend on calls or longs or futures or whatever. So here we go. So that is, right? So this is our Wednesday, right? 490. So I collected 490. Now you can spend the whole 490 if you want to. I usually like to spend half, right? So I at least secure 50% of what the risk I put on was. But I take you back to this example right here, right? We sold puts at 6,300, right? This is where we could collect money that was worth the 10%. Again, we collected 0.7 for $500 worth of risk. And then we went ahead and started going long on futures. Now, if I remember correctly, on Wednesday, I lost on my calls, right? I held them for a little bit too long. Theta started to eat at them. That money just went into the gutters. But at least the market paid me for that risk because I collected that money first, right? So in our scenario here, we said, what's the most likely scenario for price? Quickly, it ran through my head. We're probably going up, but I'm not sure if we're going to go up. So is this worth my participation then? I said, yes, it is worth my participation. There's a hell of a lot of long deltas here. So my answer number 3 is, if yes, how will I take on the risk? What are my limits? I'll take on the risk by selling puts first, and then when I believe that there is more room to go, I'll spend the credit on debiting on longs. So that's how I ran through this trade structure. This is why Wednesday was such a good day, right? And then I wanted to bring up this comment here that, so what are your limits? Meaning, like, how much are you willing to lose on the day? It's credit to my good friend Bald Eagle. He's here in the chat sometimes. I don't think he's here today, but he taught me this, and he kind of what is it? Ingrain this in my head. A good trader knows how much they can make from a trade, but a great trader knows how much they can lose. So with every trade, with every time we run through this scenario in our head, you always want to make sure like this is my target, this is my absolute stop. You guys know my absolute stop is 1,000. I'll likely try my best to not break through $1,000 of losses in a single day, right? Again, here we go. This is the thing. Right, so what if the market goes down? Then we can lose both the credit spread and the call. What would be the defensive move if that happens? So the beauty of credit spreads is that what you can do is you can buy your puts credit spreads for a loss, and then if you believe the market completely turned, if the data is suggesting that, you can then sell call credit spreads to recover from that. You could sell lower put credit spreads if you wanted to. You could stretch them out for a day. But we're not going to talk about, you could also roll them. So that's something Cedar Trades just said. We're not going to talk about rolling them today. That's defensive, right? So with credit spreads, one notorious thing that we know is that you can, so long as you have the capital, if you're in a losing position, you can say no. You can say, no, I do not accept this loss. I will roll them into the future for as long as I can until this comes back. Now, notoriously, you can kind of only do this with put credit spreads. Call credit spreads, we'll go over it again next time, but I generally don't roll calls because we know the market generally goes up. So there's been enough times where I've rolled calls into infinity. I think my max was 5 times before I gave up on them. But I just don't want to do that. That's a waste of capital. But yeah, so that's our little presentation. So again, letting the market pay you first before you take on risk. My idea is always let the market pay you first, right? Pay me before I pay you, right? In this way, it helps us just manage our risk accordingly. Now, this is why you see me every day sell puts first or sell calls, sell something before I actually start taking on the day trading. It's because this has been ingrained in this has really helped me excel and making sure that I get the cash flow that I'm looking for from the markets. I'm going to go back up here now to answer some questions. So before that, in the next episode, we're going to talk about ABJ strike selection. We're going to talk about how to trade SPX 0GT for cash flow. And then if you guys have any other suggestions, just let me know. I know I missed a couple things that I wanted to go through today. Yes, but I'm going to stop the recording first. So give me 1 second. Let me stop it first. Oh, before I stop it, those on YouTube, man. You guys like this? You guys want to see more? Comment, subscribe, like. It really helps the algo. And that's it. Now I'm going to stop the recording.